and welcome back to Financial Podcast. I'm Olivia, and today we have some really interesting and potentially impactful tax news coming out of Washington, D.C. It concerns millions of workers across the country, specifically those who earn tips as part of their income. Just recently, on May 20th, 2025, the Senate made a significant move by unanimously passing a bill called the No Taxed on Tips Act, officially designated as S-129. This is a bipartisan piece of legislation, which is notable in today's political climate, passing the Senate by a vote of 100-0 with no objections. The stated goal of this act is to amend the Internal Revenue Code of 1986 to essentially eliminate the application of the federal income tax on qualified tips. How it proposes to do this is through a deduction allowed to individual taxpayers. So let's break down what this bill actually proposes according to the text of S-129. The core of it is the creation of a new section in the tax code that would allow for a deduction equal to the qualified tips received during the year, as long as those tips are reported to your employer. This is a crucial point. You have to report the tips for them to be eligible for this deduction. However, and this is important, there are key limitations to this proposed deduction. First, there's a maximum amount you can deduct. It cannot exceed $25,000 for any taxpayer in a single taxable year. So, despite the name No Tax on Tips, if you earn more than $25,000 in qualified tips and your total income puts you above the standard deduction amount, you would still pay some tax above that $25,000 threshold. Second, not just any tip qualifies. The term qualified tip is specifically defined. Generally, it means any cash tip received in an occupation that traditionally and customarily received tips on or before December 31st, 2023. The bill actually requires the Secretary of the Treasury to publish a list of these specific occupations within 90 days after the act is signed into law. The bill does specifically mention food or beverage service and beauty service establishments, including barbering, hair care, nail care, aesthetics, and body and spa treatments, where tipping is customary. Third, there's an exclusion for certain employees based on their income. The deduction for a qualified tip would not apply if, in the preceding taxable year, that individual's compensation from their employer exceeded a certain amount. This threshold is tied to the definition used for determining highly compensated employee status for non-5% owners. For the 2025 plan year, based on 2024 compensation, this threshold is $160,000. The aim here is to prevent high-earning individuals from utilizing this deduction. Now, how this deduction actually works within your tax filing is also outlined in the bill. This deduction would be treated favorably. It would be allowed for non-itemizers, added to the list of deductions in Section 63B. For those who do itemize deductions, it would not be treated as a miscellaneous itemized deduction and would not be subject to the overall limitation on itemized deductions. This essentially means it's a direct deduction from your gross income, like adjusting gross income deductions, whether you itemize or take the standard deduction. The Treasury Secretary would also need to modify tax withholding tables and procedures to account for this new deduction. If this bill becomes law, both the individual deduction for qualified tips and the proposed extension of the employer tip credit to beauty service establishments would apply to taxable years beginning after December 31, 2024. This means that if it passes soon, it could potentially impact your 2025 taxes, which you would file in early 2026. One interesting point highlighted in the sources is that the bill is structured as a tax deduction rather than an income exclusion. While both might achieve a similar result in terms of your federal income tax liability, using a deduction means that the tips are still considered income and reported to your employer. This is important because having that documented income is beneficial for things like applying for loans for a house or car. Furthermore, the deduction structure protects the ability of tipped workers to contribute the full amount of their income, including tips, towards Social Security and retirement accounts like IRAs. However, crucially, this bill only addresses federal income tax. It does not provide a payroll tax break. This means you would still be required to pay Social Security and Medicare taxes on your reported tips, even if you claim the income tax deduction. Now, passing a federal bill is one thing, but state taxes are a separate matter. For workers to be fully exempt from state income taxes on tips, states must decide whether to conform their tax laws to this new federal policy. If a state doesn't conform, a taxpayer earning, say, $100,000 in tip income might have their federal taxable tip income reduced by the deduction, but the state could still tax the full $100,000, potentially resulting in a significant state tax burden. The sources note that almost a dozen states have introduced similar proposed bills for their 2025 legislative sessions, but none have passed yet. So if you're a tipped worker, you'll need to watch closely to see if your state follows suit. The idea of eliminating federal taxes on tips has actually been discussed by both major parties, with President Trump campaigning on the promise and Vice President Harris also embracing the idea. While the Senate bill passed unanimously, it's not without its critics outside of Congress. Some analysis suggests that a significant portion of tipped workers, perhaps around a third, already pay no federal income taxes because their overall income falls below the standard deduction. For these workers, this new deduction wouldn't provide any additional benefit. Also, workers in jobs that aren't deemed traditionally tipped or managers who are legally restricted from receiving tips would not benefit. Groups like the Committee for a Responsible Federal Budget express concern about the cost, estimating it could be upwards of $100 billion over a decade. They argue it's an expensive tax giveaway to a specific group, adding complexity to the tax code rather than simplifying it. Labor groups like One Fair Wage view the bill as a distraction from the real fight, which they believe is raising the minimum wage and eliminating the sub-minimum wage for tipped workers. They argue that real relief from the high cost of living comes from increased wages, not just tax breaks on existing tip income. Some analyses also suggest that exempting taxes on tips could potentially encourage tax avoidance or reduce pressure on employers to increase base pay. There are also potential practical challenges, such as ensuring consistent reporting and wage/tip classifications. It might also create friction within businesses, particularly in the restaurant industry, between highly tipped workers, who benefit significantly, and those who are lightly tipped or not tipped at all, like cooks, dishwashers, or managers. Restaurant owners themselves, already facing rising costs, might face pressure for compensation increases from employees who don't benefit from the tip tax deduction. So, where does it go from here? The Senate-passed bill now heads to the House of Representatives for consideration. It's worth noting that the House has its own tax package, sometimes referred to as the One Big Beautiful Bill, which also includes similar, though not identical, provisions for a tip deduction. A key difference mentioned is that the House version is part of a much larger, potentially more controversial bill with other tax cuts and political priorities. And it explicitly limits the tip deduction to tax years 2025 through 2028. The Senate bill doesn't appear to specify a temporary time frame. For the Senate bill to become law, it needs approval in the House and then President Trump's signature, which is expected given his campaign promise. This is a developing situation, and the final form of any tax relief for tipped workers will depend on the legislative process in the House. For millions of tipped workers, this bill, if enacted, could mean keeping more of their hard-earned money, but it also has limitations and raises broader questions about tax policy and wage structures. We'll keep an eye on it here on Financial Podcast. Thanks for tuning in. Don't forget to like, subscribe, and let me know what you think about this potential tax change in the comments below. See you next time.